Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Today we'll be talking about understanding the FAFSA process and in turn understanding how you can make moves to qualify yourself for more college financial aid. Now there's a common misconception out there that I make too much to qualify for financial aid or I have too much in assets. While in some cases that is true, there's a lot more cases that we see where people think that, where if they just made some adjustments and some moves a few years before their kids went to college, they could have opened up a good portion of financial aid for those 4 years of the undergraduate degree. So today we'll be kind of talking about the FAFSA process so you know when they're going to take the snapshot of your assets and income for purposes of qualifying for financial aid. We're going to go over a number of the strategies that we use with our clients that help them qualify for more aid. And also we're going to be talking about the difference in the financial aid process between a public college and a private college. So how is financial aid calculated? So it's a pretty straightforward calculation. The Department of Education has this term called the expected family contribution, or EFC. So the expected family contribution is part of this equation. That's the amount that you are expected to pay out of pocket before you get to any type of financial aid that's going to be offered to you. So the equation is total cost of attending that college minus your expected family contribution equals your financial aid package. Now that EFC, what is in that number is assets and income of the parents and assets and income of the incoming student, and they're weighted differently. So let's first take a look at the assets of the parents. So here's an illustration that shows you how the parents' income and assets are weighted in the formula. So if you look at this, you can see the income side. The parents' income counts 22 to 47% of their AGI, or adjusted gross income. The reason why there's a range there is it depends on the size of the household, so the number of people in your household, and the number of children you have attending college during that school year. So that's why they show a range instead of a defined percentage. Now on the asset side of the picture, you see that 5.64%. So any assets that are owned by the parents that are considered countable assets, that counts towards that 5.64%. So example, so if you have, let's say, a brokerage account with stocks and bonds in it and it's $100,000, basically about $5,600 of that asset is going to count against your financial aid for the upcoming school year. And later on, we're going to go into more detail as far as what assets are counted and what assets are not counted. So what you'll also find is it's not just a straight up formula. There are some protections put in place for a certain amount of income and a certain amount of assets, depending on, again, how many people are in your household and how many kids you have in college. So let's first look at the income protection allowance table. So what this table shows is this is the amount of income that you're allowed to protect. Your AGI you're allowed to protect based on the number of people you have in your household and the number of kids in colleges. So for example, let's say there's 2 parents and 3 children, so that's a 5-person household, and let's say you have 1 student going to college. So if you look in that column, that means of your income that you're going to report to FAFSA, $33,720 is actually protected and excluded from the calculation, and any amount over and above that, that's counted against that range of the 22 to 47%. Likewise, there's also an asset protection table that we'll look at here that protects your assets based on your age. So you can see the age of the oldest parent is located in the one column, and the allowance that each parent gets is in the adjacent column. So you can kind of see if the oldest parent is, let's say, 49 and there are 2 parents, then you get to protect $12,200 worth of assets that won't count towards that 5.64 in the formula. So looking at what assets are counted and not counted, let's first look at the assets that are specifically excluded, that are not counted towards that asset allocation for the parents. So first and foremost is retirement accounts. So any 401ks, 403bs, traditional IRAs, Roth IRAs, any retirement accounts do not count as an asset for purposes of FAFSA. Pensions, so if you have pensions, they don't count as an asset. The equity in your primary residence for many schools does not count as an asset for purposes of financial aid. And lastly, if you own a small business and that small business has less than 100 employees and your immediate family owns 51% or more of the business, that also does not count as an asset for purposes of financial aid. So the assets that are specifically included in the asset formula are, surprisingly enough, balances in 529 accounts. So you set up these accounts for your kids to save for college. They're actually counted as an asset of the parent because technically you own them. So that counts as an asset in the financial aid formula. Family-owned businesses that have 100 or more employees, or you have 50% or less ownership, those will count as an asset for purposes of FAFSA calculating your financial aid. Also, if the child is a beneficiary of a trust, they might not be receiving money from the trust right now, but actually those trust assets count as an asset for financial aid purposes. And lastly, real estate. So people have real estate as investments, even though they might wrap that with an LLC or some type of corporation and say, oh, well, I own 51% or more of that, so that won't be a countable asset. FAFSA looks through that and said if it's real estate that you own and you passively own it, that's counted as a real estate amount and not as a family business, and that will count as a financial asset for purposes of the FAFSA formula. So let's switch gears over to the student side of the equation, which has different weightings for their income and assets. So take a look at this. So this shows a quick snapshot. So the student's income, 50% of that income over a certain threshold counts against financial aid, and 20% of any asset in the name of the child counts against financial aid. So when you compare the parent's weighting versus the student's weighting, you can see you're penalized a lot more for having assets in the name of the child in a big way. Because if you have, and this is one of the most common mistakes we see people make when they're doing their college planning, instead of using a 529 account, there's money sitting in an UTMA or UGMA account that's been accumulating for a number of years, and let's say there's now $30,000 in that account. Even though that was set aside for the child for college, UTMA and UGMA accounts are technically assets of the child. So if there's $30,000 sitting in that UTMA account, times that by 20%, so that means $6,000 a year is going to count against the financial aid process, which means over a 4-year period, you might have just lost $24,000 in financial aid because you were holding an UGMA account instead of a 529 account, and it could have qualified you for more aid. Let's look at the formula as a whole now with both the parents' and students' assets and income. So you've got the parents' assets and income weighted, you've got the students' assets and income weighted. That will result in your total EFC, which again is the amount that you are expected to pay out of pocket each year. Now, the other thing I've included in this illustration is if you look at the bottom of it, are the grandparent-owned assets. So they do see how there's a zero there. So assets owned by the grandparents are actually invisible to financial aid. So this is actually one of those strategies that we have clients put into place, that if the 529 is being accumulated by the parent, that counts as an asset of the parent and it counts against your EFC. But if the 529 is being accumulated by the grandparents and they are the owners, that does not show up against financial aid at all. Now, there are some big pitfalls that we have seen with these grandparent 529s. While they help potentially you qualify for more aid, you have to be very careful about when you take distributions from those accounts, because from grandparent-owned 529 accounts, if you take distributions any time before the spring of their sophomore year, even though it's not looked as an asset, those distributions are now counted as income of the student when you file for the FAFSA process, which you have to do each year. So if you have grandparent 529 accounts, just be careful when you actually use them and distribute them. And there's also other little quirks that you have to be aware of, and I'll include a link at the bottom of this video so you can reference the article there. I want to give you a quick snapshot of the type of results this formula creates. So if we look at an example, so this is an example of a 2-parent household. There's 2 children in the household. One's attending college and one will still be at home. The child attending college has no assets or income, and the oldest parent is age 49. So if we look at this summary table, this shows on the left-hand side their combined income, AGI. The top has all of their assets with all those exclusions for FAFSA processes. So if you look, you can kind of find your income on the left, find your assets on the right, and you'll find ballpark what your FAFSA award might be if you were kind of in this age bracket, this family size. So for example, this family, if they had a combined 150,000 income and they have 100,000 in countable assets, that means that they would have an EFC of 33,737 for that school year, which means that's their out of pocket. Now, what does that mean? So if you have a $33,000 expected family contribution, and let's say they want to go to like a state school that costs $26,000, that means you're on the hook for it all. There is no financial aid because your expected family contribution is higher than the total cost to attend. However, if they go to a private school and the private school has $60,000 a year and your EFC is 33 and the private school adheres to the criteria pretty closely to what FAFSA does, then you might get some aid based on your income and asset picture. This is where the road splits between private colleges and public colleges. So public colleges adhere to the FAFSA and the EFC and everything we've talked about up to this point. The private colleges do not get federal financial aid, so they don't have to adhere to that criteria. They can pretty much do whatever they want. So private colleges, in addition to filling out the FAFSA form for your student, you're also going to have to fill out most likely the CSS profile form, which has additional information that's requested over and above FAFSA. So there's deviations in the awards because there's deviations as what they count as an asset. So for example, if you have a 100% family-owned business with less than 100 employees, that's invisible to FAFSA. If they go to a public college, they're not going to look at it as an asset. The CSS profile does count that as an asset. Another example is the equity in your primary residence. Like I mentioned with FAFSA, doesn't count. CSS profile form, they ask you for that information. And another big one we see in like divorce cases is with divorce, with the FAFSA process, they only look at the assets and income of the custodial parent. They ignore the assets and income of the non-custodial parent. However, with the CSS profile form, they look through that and say, nope, doesn't matter. We're going to look at assets and income of both of the parents. So we have seen cases, and it sounds odd, but people will complete the FAFSA and the CSS profile form, and let's say it's a $50,000 per year college, and they get no financial aid, but then they apply to a public institution that doesn't count all these extra assets that the CSS profile form does. And let's say that public college is half the price, but for some reason they got $5,000 to $10,000 in financial aid because of the difference in the equations. So I'm going to share with you kind of the top 10 ways or strategies that we use to help our clients qualify for more financial aid, and here they are. So number one on the list is really get assets out of the name of the student because they're penalized more because of the percentages. Grandparent owned 529s are very valuable as long as you know the special rules associated with them. Use countable assets of the parents to pay down debt. So in a lot of financial aid processes, they don't care how much debt you have. So if you can take a countable asset and pay down debt with it and still afford to pay for college, that can increase your financial aid. Move UTMA and UGMA accounts to a 529 UTMA or UGMA account because then it shifts it from the asset of the child to the asset of the parent. Increasing contributions to retirement accounts. Now that doesn't help you all years for financial aid, but because the year they go in, making retirement contributions in that first year does not reduce the amount of income, but it will for the 2-year look back that we're going to talk about in a little bit. So minimizing distributions from retirement accounts. So normally when you take distributions from retirement accounts, it's additional income on the table. So you don't want to put additional income on the table when you're in these determination years for financial aid. Minimize capital gains and dividend income. So if you have, real estate you're going to sell, or if you have investment accounts where you're moving assets around, you just have to be very careful of the amount of realized capital gains and dividend income that are peeling off of those investments. Accelerate necessary expenses. So if you have a business and you have a way of reducing your income by increasing the amount of expenses to it, that might be beneficial during those determination years. Using a home equity line of credit instead of a home equity loan. They count differently for FAFSA process. Families that own small businesses have a lot of advanced planning options. So if you have a small business, there's a lot you can really do to say, this is how much income I'm going to realize and show in these years. These are the amount of expenses. This is how much salary I'm going to take. So we can get very creative with small business owners as far as how much income and assets we can show from a FAFSA process. It's important to understand when FAFSA takes a snapshot of your assets and income, because that's what's really going to determine your EFC calculation. And FAFSA a few years ago changed the calculation to say we're going to look at income from 2 years prior to when you're filing for FAFSA. And the reason why they did that is it used to be the year before. So if your student was going to college in the fall of this year, they were just looking at the previous year's income. Now they're going back 2 years, and the reason why they did that is most people, when the FAFSA application came out, they didn't have their taxes filed yet, so they didn't know what their income was. So they're like, we're going to solve that problem. We're going to look back 2 years, because by then you definitely know your income, and then they can check that income against the IRS database with your FAFSA form. So when you start doing this planning, if you think about a 2-year look back, so if they're going to the college this year, they're actually looking at your income from when your child was in the spring of their sophomore year. So we really got to start looking at the possibility of shifting things around to potentially qualify for more aid well in advance. Now, if you're watching this and you already have a student that's, let's say, a senior or a freshman in college, there's still an opportunity to do planning, because again, it's going to impact you 2 years from now, but it's like you might have lost the first 1 or 2 years because you're going to be qualifying based on that 2-year look back period. Now, the 2-year look back period is for income only. So that's really the income piece of the equation. The asset piece is actually the balances are dictated on the day that you file the FAFSA application. So there's actually shifting that we can do, and some of these strategies we can implement all the way up into when you're actually filing the FAFSA application for that upcoming school year to qualify you for more financial aid. And remember, the FAFSA application is filed every single year your child is in college. So each year you got to be kind of thinking about, I don't want to be realizing a lot of taxable income, or I should be making these asset shifts, and being very careful in those years if you think you're going to have a shot at qualifying for financial aid. As always, if you have any questions on any of the topics we talked about today, please feel free to reach out to us at moneysmartboard.com. Thank you.